Let's get to our panel for some more reaction on this. And Steve, I'm going to start with you. That participation rate is something you had been pointing to ahead of time. This is a good number.
Yeah, and I'm going to echo Rick again. I mean, it was something Goldilocks about it. It's a strong number, remember. The normal run rate of this economy may be 100,000 jobs if you're putting to work all the people that are coming into the workforce. Obviously, there are people to put to work who have left the workforce, so there's more work to be done. So this is an above-trend growth number, and it happened with more people entering the workforce, and that's a good number. And wages were lower. If I have this number right, I have 0.3%. We're looking for 0.4, so maybe some deceleration there, more people coming in. I did see a 344,000 rise in the unemployed. It's something to think about, something to be a little bit concerned about, but maybe not so much, because you could think that people would leave their job, spend a little time in unemployment, and in a hot job market, find employment in the coming months. Mike Santoli asked me earlier this morning about the difference between the employment and the household survey. The establishment household survey. Household survey actually showed 440,000 growth, so that's come along. Overall, I think this is a neutral report for the market. It doesn't push the Fed further ahead, doesn't keep them back any. You did get that participation. If people keep coming back in the workforce, that could ease the inflation problem. Becky?
All right, Neela, let's go to you because you were the closest at 290,000. So this was basically what you were anticipating. Any surprises here for you?
Well, only good ones. The fact that the labor force participation rate went up is a good thing for the labor markets. In fact, the fact that the numbers lined up, I read the unemployment rate uptick is also positive because we know that the slowdown in hiring, some of that was just the lack of supply. There was a lot of firm demand out there, not a lot of workers to meet that demand because the workforce has shrunk. So the fact that the unemployment rate ticked up may mean that people have been lured back into the labor market by higher wages, more stable health conditions on the ground, schools back in session. I think that reads well for the labor market, but I caution that we will likely see a more normalization ahead and slower monthly gains heading into the fall.
Hey, Tyler, when the Fed officials who have been talking about more pain to come to the labor markets, is this kind of what they're talking about, unemployment going up to 3.7%, or do you think unemployment will go significantly higher from here before inflation's under control?
I think it's going to be higher than 3.7% before inflation is under control, and certainly higher than 3.7% before inflation is back to 2%. I'm not surprised by the strength of this number because when you look at the fact that we still had 11 million job vacancies, more than 11 million job vacancies in July, when we still have negative real wage growth, that's a big incentive for firms to continue hiring, to fill those unfilled jobs, and to hoard labor. And when you look at the fact that we still had a labor force participation rate that was a full percentage point below pre-pandemic levels, then I think that was all a recipe for a pretty strong job number. But yes, to your question, I think we're probably going to be looking at a higher unemployment rate moving forward. And one sort of leading indicator of that is that we did see average hours tick down. So usually the pattern here is that we see job vacancies start to come down, employers reduce job openings, and then they start reducing hours, and then they start reducing hiring and introduce layoffs.